Okay, excellent. We've learned about working capital management. This is one of the most sophisticated aspects of financial management. However, it is vital for companies to succeed in it, as it is a valuable lever, particularly when the economy cycle is not so favorable and financing sources are scarce. The story we would like to share with you here is a real-life story. We'll cover the actual process that a company went through. And that's valuable because this case study will illustrate to you how the concepts we've seen so far are applied in practice. 𝗘𝗃 Industries is a global company operating in the sector of specialty chemicals and materials. This is a manufacturing business selling products all over the world. Nowadays, 𝗘𝗃 has been acquired and merged into the Belgian chemical company 𝗘𝗏. The transaction took place in 2015. And the price 𝗘𝗏 paid to acquire 𝗘𝗃 was $5.5 billion. However, we'll study 𝗘𝗃's case because it is very good. Just before the crisis of 2008, 𝗘𝗃 Industries management foresaw that the economic cycle would soon deteriorate. The company, headquartered in New Jersey, experienced several years of strong growth before 2008. However, management knew 𝗘𝗃's business is correlated with the economic cycle. Not perfectly, but still highly correlated. In addition, they realized the company's bond financing maturing in 2010 could be a ticking time bomb, given that it soon became clear this wouldn't be an ordinary crisis. When banking giants collapse, it takes at least several years for the economy to recover and for financial markets to function as usual. Therefore, it would have been very risky to rely on improved market conditions in 2010 when the bond expires and not preparing for a plan B. Moreover, the firm's bank debt involved heavy covenants that were particularly onerous, and 𝗘𝗃's management team was eager to repay such a loan as soon as possible, in case financials allowed that. In the grim situation we described above, 𝗘𝗃's management team saw the forest for the trees. They knew the financial markets and investors would be interested in one thing: cash and cash flow generation. In these years, investors were careful and wanted to be sure the company they invest in can weather the storm, having sufficient cash on its balance sheet. Not an easy task, particularly when the business has been expanding for a few years and considering that 𝗘𝗃 acquired an external company. This resulted in growing working capital needs, which impacts cash flow generation and availability negatively. In good times, management is interested in the P&L. They want to know about profitability. If everything goes well, the balance sheet becomes of secondary importance. But in bad times, the balance sheet comes first. Sources of financing and efficiencies are in the balance sheet. 𝗘𝗃's managers knew the main lever, and probably the only one that is in their control, is working capital management. Inventory, trade receivables, and trade payables. The first preliminary analysis carried out by company executives came out with the conclusion that inventory is the item that represents the most significant working capital reduction opportunities. The analysis valued that the company's working capital invested in the business was higher than the competitors, and that the firm had more than $200 million in excess working capital. We recognized the opportunity to tap excess working capital to invest in the business that will shape our future, says 𝗍𝗿, 𝗘𝗃's Vice President and Chief Financial Officer. When the economy began to deteriorate in 2008, we decided to accelerate this effort. But before starting the initiative, 𝗘𝗃 involved a specialized consultancy firm. They chose 𝗘𝗏, a consultancy company focused on cash flow optimization. Hiring a specialized consultant soon paid off. 𝗘𝗃's executives communicated to 𝗘𝗏 that they have two main goals in mind: preserve an excellent customer service, achieve optimal working capital efficiencies. After interviews, meetings, site visits, and segmentation of clients and suppliers, 𝗘𝗏 consultants came up with a surprising insight. They stated potential efficiencies exceed the $200 million mark, and they expect trade receivables and trade payables will soon be the major contributors for that. Both 𝗖Tech and 𝗖𝗄𝗃 agreed that if the plan was to work in a sustainable way, it was up to the firm's employees to put more focus on incorporating working capital management in their daily duties. We want our people to understand how their day-to-day activities affect working capital, says Scott Hain, Vice President, Global Supply Chain, 𝗖Tech Specialty Chemicals. Anytime an individual makes a decision, he or she should ask, what impact will this have on working capital? And that's certainly the right way to approach such a project. Lower-level management must hear this from senior executives and understand that working capital optimization is a real focus for the company. 𝗖Tech and 𝗖𝗃 came up with 3 points that had to serve as a cornerstone for the initiative. Standardize collection processes geographically and introduce collection policies for different customer profiles, implementing a rigorous escalation process aiming at reducing overdue receivables. Update inventory reorder levels and implementing a system improving order quantity. Negotiate a new payment with suppliers, allowing the company to pay a little later when possible, and applying a payment clock, a mechanism ensuring invoices aren't paid before they are due. Many suppliers were flexible enough to renegotiate and prolongate 𝗖Tech's payment terms. In addition, uniform policies and criteria across geographies, coupled with a stronger focus on collection, resulted in an additional boost for the company's working capital situation. Such quick wins validated the entire project and proved it can succeed across the organization. And that's important because it secures executive-level support and attracts attention from other employees. As you can see in the chart we have here, early on there were significant improvements of working capital in days sales outstanding, days inventory outstanding, and days payables outstanding. 𝗖Tech's supply chain VP, Scott Hain, said, "We were able to generate some quick wins, particularly in the payables and receivables area. Once people saw the successes, everyone wanted to be involved." He also believes the initiative helped the company's culture evolve. This project, for example, brought new exposure to the credit group and emphasized the importance of its role in facilitating collections rather than just managing credit risk. Company executives also highlighted that the project succeeded because 𝗖Tech and 𝗖𝗃 created a series of metrics and dashboards that allowed operating units, account managers, and top executives to monitor the development of the working capital improvement plan. There are 2 reasons this is very important. First, it brings a sense of accountability. And second, people are interested in seeing the actual results of their efforts. I'm sure you can imagine this is a success story. The company had the right approach and sustained working capital improvements for the next several years, before it was acquired in 2015. Importantly, optimized working capital and more than $400 million deriving from it allowed 𝗖Tech to weather the storm and sail safely when financing was scarce and rather costly. Hope you enjoyed this case study. See you in our next lesson.